The global economic outlook has deteriorated since the end of last year, and the European crisis in particular is the biggest potential threat to the world economy and therefore to the New Zealand economy. Leading forecasters like the IMF, World Bank and Consensus Economics are expecting world growth to be weaker over the next couple of years than previously predicted. For the most part, that is because of the ongoing turmoil in the euro area. The most likely outcome is that the European countries manage through the crisis with the euro intact, because it is in their collective interests to do so. But that is by no means guaranteed. As recently as yesterday, the IMF warned that if required actions are not taken, the European crisis could spill over into a global recession. Even under the most likely scenario, where Europe avoids a full-blown crisis, the euro countries are expected to go into recession in 2012 and will be in for a protracted period of sluggish growth thereafter. This poorer growth outlook for Europe has in turn contributed to lower growth forecasts for Asia, including China. Overall, growth in China is expected to remain strong, but an easing in that growth will still have a flow-on effect for Australia because of lower demand for minerals. The outlook in the United States is actually looking better than it did this time last year, but growth is still likely to be subdued. So what does all of that mean for New Zealand? Well, weaker global growth, particularly our key export markets in Asia and Australia, will put downward pressure on the demand for our exports. That will have a real and noticeable effect on the New Zealand economy, which is expected to grow somewhat slower than was predicted at the end of 2011. But it won't knock the New Zealand economy for six, and it certainly won't stop the government pushing ahead with its priorities. We are a small economy doing the right things. Our banks are in good shape, and the government has managed effectively through the difficulties of the past 3 years. The really difficult challenges will start to come if the world's growth continues to be revised further and further downwards, or if the European crisis triggers a global credit freeze. Those are not the most likely scenarios for the world economy, but they are certainly possible, and the government will continue to monitor global events very carefully. So given that international backdrop, I want to talk some more about each of the government's priorities: responsibly managing the government's finances, building a more competitive and productive economy, delivering better public services, and rebuilding Christchurch. Our first priority is to responsibly manage the government's finances. As every household and business around the country knows, that involves living within your means, budgeting carefully and deciding which things are priorities and, most importantly, which things are not. The government is committed to returning to surplus in 2014-15. Sticking to this commitment is an important part of our plan to limit debt and take pressure off interest rates and therefore the exchange rate. And sticking to this commitment is also important for New Zealand's credibility with international financial markets. As we've seen overseas, a loss of credibility is a very difficult thing to reverse and can have widespread effects across the country. As you'd expect, the forecast slowdown in world growth makes our surplus target harder to achieve. But today I can confirm that we are still on track to post a surplus in 2014-15. The upcoming budget policy statement will show a forecast surplus in the range of $300 to $500 million in that year. Given the events in Europe, the surplus is understandably smaller than that was forecast in the preview, but we still remain on our tight fiscal track. You'll see a fuller picture of that in the budget policy statement, which will be released on February the 16th. The next update after that will be in the budget itself. The budget will set out the government's revenue and spending and show exactly what we are doing to meet our fiscal targets, get back to surplus and start reducing debt. If the international outlook worsens between now and the budget, we may have to do more than we are currently anticipating to reach our surplus target, bearing in mind that that target is still 3 years and many forecast revisions away. If the absolute worst happened and there was a major shock to the global economy, the government would look at whether retaining the surplus target would actually harm the economy by forcing a sharper reduction in demand. But outside that scenario, we remain firmly committed to our target for surplus in 2014-15.